Want my latest market insights? My latest report, Uranium Trend is En Fuego, is now available. Scan this QR code or click on the link in the description.
This decoupling on the consumer lending sector is an article that I wrote back at the end of September that the consumer lending sector is in trouble. So we have Wall Street and then we have Main Street, and they're quite bifurcated. So I write a lot about the employment backdrop as underpinning the complacency and or the rising risk. And I have not been bearish on a recession, as I mentioned last June of 2024, again in December, again in June of 2025, until the end of this year, because the employment trends have been degrading underneath the surface, that which I track. So big picture, no need to panic until there's a reason to. But the point is, I could see this degradation underneath the surface. And then, of course, over the past 2.5 years, we got revised job growth numbers in, and it equaled 2.5 million in revisions lower. So this is the problem with revisions, actually. They go from March to March, and then they're announced in September, August timeframe, and then they're actually the final numbers aren't delivered until the following January, February. So it's a massive lag. So I have to find other vehicles to track this weakness. And my point was in saying in the last few posts where I've written about this is that we've lost our buffer. So we had a buffer last September of 2024 when we had an 818,000 job growth revisions. And then lo and behold, the Fed did a surprise 50 basis point rate cut. We still had a buffer. Now, fast forward to this particular August non-farm payrolls, when we still had the government open and BLS was working, they had a revision of 911,000 losses, and the Fed only cut 25 basis points. Why? And I said this even before they announced. I said, if they cut another 50 basis points, they're going to be admitting we've got recession risk pulled forward. It'll be faster, and the market will not like it. So they only went with 25 basis point cut, and there's talk about how many they're going to do moving forward. But the reality is they're between a rock and a hard place. They cut too aggressively. Inflation picks up. It already has. We don't have a deflation impulse when it comes to real prices. What we do have is weakness in the employment market, and we've got disposable income falling, which obviously leads to more concerns at the consumer levels, but that will eventually lead to consumer spending downturn. Right now, we've got the top 50% making this spending look robust, but that's the K-shaped economy. So we've got this situation where the Wall Street gains benefit the top income earners, not the bottom. The inflation helps the top income earners, definitely hurts the bottom. And I'm not just talking about auto lending as a canary in the coal mine. I'm talking about the aggregate consumer lending market has slowed from mortgages to what have you. And it doesn't mean that the housing market is going to be a bubble and break. No, we're still in a lot better situation than whatever you read by the foreclosure bros. I'm not a foreclosure bro as it relates to housing. That is an inflationary asset. It's part of this monetary illusion that prices are much higher assets that are inflationary because of the falling value of the dollar, because of this absolute fiscal dominance that has also caused the Fed to buy mortgage-backed securities. So they talked yesterday, Powell talked yesterday, how they're going to slow and then the quantitative tightening in their balance sheet, but they never mentioned selling any MBS holdings because that would immediately reprice the housing market. So there's a lot of bid in this market that is government driven, and they don't want, meaning, of course, Trump, Percent, et cetera, don't want to create volatility in the equities market because then they lose their base. Then they lose the tax receipts that come. And by the way, 97% of tax receipts are paid by the top 50% of income earners as well. So we're not really looking at Main Street as much as we're just focused on Wall Street. And I think that's terrible. But that's what the market continues to price in, the ability to have the consumer keep spending, for the earnings growth to expand, and for the Trump administration to basically do whatever is necessary from a policy intervention standpoint to keep the market from rolling over. Once it starts, obviously, we're going to be in a different situation because it's a credit cycle, and it will be just like every other credit distress down cycle, but we're not there yet.
Join Club to trade with Samantha. Scan this QR code or click the link in the description.